Stock market is hitting all-time highs again. The stock market will continue to soar further given the economy we have right now. SPY ETF just hit 607.50, new all-time high. QQQ kind of lagging. DIA, the ETF for the Dow, kind of lagging a little bit, but SPY ETF, the more broad 500 stocks in that one, did hit an all-time high. Given the current economy, will continue. The stock market will continue to move higher. We did not get, as promised, tariffs from Trump. Instead, he kind of punted down the road a little bit. He sat there and said, maybe February 1st. But what the executive order he did push out was, take a look, see if there's anything unfair. We'll take care of those particular actions right now. We were promised something else. The stock market itself had geared up for a very long, slow grind lower. We didn't get that. But it's not to say it's not going to happen. In the meantime, the economy will push the stock market further until the Federal Reserve realizes they blew it again. We've got a Fed meeting next week. Let me break down all the little bits and pieces why I believe SPY ETF continues higher for now until the Federal Reserve steps in and says, oops, let's jump in. Here we're looking at SPY ETF. And again, it hit a new all-time high. The print on this is 607.08, some pennies. But as I'm putting this video together, this is 10 o'clock Mountain, 9:30, something like that. It already hit a bigger high. Not much. QQQ ETF is following. DIA ETF, of course, for the Dow. That one is following as well. They're lagging a little bit, but generally speaking, we start with the economy. Now, I did a bunch of videos going into the end of December, starting to do videos going into the rest of this year. And the idea is simply this: stay ahead of the curve. How can you make money in the stock market? I'm going to break down how I will be making money specifically next Wednesday with the Federal Reserve meeting. I just did a video yesterday. SVOL ETF. It is an inverse ETF. And Wednesday is an excellent day for me to jump in. The Federal Reserve is very likely to come to terms with the fact that they lowered interest rates too fast, too soon. And because of that, they're probably going to figure out some way to say, oopsie. Either they push interest rates back up higher or they contract their balance sheet at a massive pace, which would restrain the economy somewhat. And I'll break that down. But let's first take a look at what is driving the economy itself. The economy is strong. We just got jobs report, what was it, the 10th? Yeah, I think it was the 10th of this month. Huge, 256, totally unexpected. Except if you go back in my videos, I said, I'm looking for 250. I never try to call these numbers, ever. I always say, we'll see what happens. But this economy is being pushed rapidly, and it all is driven by the money supply, the growth rate of the money supply. People sit there and say, you know what, the President of the United States and his economy, you can stop right there. The President of the United States doesn't really do a whole lot when it comes to an economy growing it. Little tweaks here and there, little ones. Now, this particular president could derail this economy. And I think the Federal Reserve kind of geared up for the fact that we could see a derailment. We're not going to see that, it looks like. We're going to see a very muted response, and because of that, the markets are shifting. Let's go through some charts, and I'll kind of break all this down for you. This is DIA ETF. As you can see, lagging from the all-time highs, up for the day. QQQ ETF, again, lagging on its all-time high peak, moving higher today. Looks like it wants to take out these numbers. It's just a matter of when QQQ ETF hits these all-time highs. So what drives this? And it really boils down to the economy. Here are interest rates, which are moving lower. We expected Trump to come up with some pretty bad things, ideas. And Since September, when it became apparent, two things. Number one, Trump will win. Number two, it will be bad. The bond yields moved higher and higher and higher. This is the U.S. 10-year Treasury yield. It is moving back off of its highs that it's been. It eclipsed the highs from earlier, but not all the way back. The two things are the tariffs and the tax rollovers. We're probably not going to get as much tariffs as we thought, which would be something that the economy could probably swallow. He'll put some tariffs up for a period of time. Eventually, he will gain one little thing and say, look, I fixed the world. I'm so awesome. Not really, but the economy itself will probably move forward just fine if it's not an across-the-board, broad-based tariff. Number two, we don't know what the Republican-controlled Congress is going to push forward with taxes. Now, very likely, they will sneak the taxes into the budget, which forces the Democrats in the Senate to kind of go along with it because there's no choice. Avoiding the filibuster, pushing legislation through. Corporate tax cuts, deficit pushes the long end of the yield curve higher, which is costs for consumers, mortgages, car loans, things like this. So seeing the 10-year kind of back off a little bit because of the lack of tariffs is good news for SPY ETF, moving higher and higher. But this is really the thing you should be looking at. And if you do any kind of construction, go ahead and get yourself a sort of a level there and ask yourself the question, okay, so the Federal Reserve expanded its balance sheet and created new money in response to the COVID shutdowns. You could see that big jump higher. They just pushed and pushed and pushed. And then they sat there and realized, hey, all this inflation, I guess it's not transitory, that it's actually inflation. They blew it again. I sat there in some of my videos back in 2020 saying this will be an apocalypse. This is so much money. This is ridiculous. We got inflation, plain and simple. When you pump that much money into the system, price pressures move higher. The stock market moved up, so if you're in the game and you're ahead of the curve, you can make money in the stock market in a situation like this. But the Federal Reserve then realized, caught on, oh wow, this isn't just going to go away. We actually need to take action. They pushed interest rates up, they shrank their balance sheet. Fine. Here's the thing though. Despite the fact that the Federal Reserve is reducing its balance sheet, commercial banks are taking up the slack. And one of the key aspects of it is, look at the 10-year Treasury yield. Trading at 4.6, call it that. Commercial lending is sitting there saying, okay, a 10-year loan is going to cost us 4.6 plus 2 maybe. Whatever their interest rate, maybe they're paying 5.25, 6.5, whatever they may be paying a commercial loan. All right, they're sitting there saying we can borrow 100 million, a billion, whatever it might be, and earn a better rate than inflation and the cost of our interest rates. Inflation's running about 3%. The Federal Reserve's target rate is about 2%. So these institutions believe that they can outpace the interest rate and inflation and be profitable. That should be a huge red flag for anybody sitting there saying, that's inflationary. Plain and simple. This is the definition of hyperinflation, if you will. Because these are abnormal growth rates. These are abnormally high numbers. Relative. And if you took a level and you kind of looked at that, you could see that the last peak, even though the Federal Reserve shrank and commercial banks are expanding, that last little sort of line right there is sharply higher. And here's a better look at it. This is the M2 money supply year over year change. And this really kind of This is the foundation of my economic sort of analysis when I ask the question, what's going to happen next in the stock market? And I use economic data points. This growth rate is above 0%. Remember, the Federal Reserve shrank. Now, commercial banks are expanding. So that money supply, the M2 money supply, is a combination of the Federal Reserve reducing, commercial banks increasing. The growth rate above 0%, getting close to the median level, will not just hit the median and go flatline and everything's perfect. There will be growth rates across the board in price pressures. Let's break this down. This is personal incomes versus M2 money supply. Growth rates. All right, what happens? All that commercial lending turns into people being hired. 256, January 10th. After, what was it, 248? We're seeing big jumps in jobs. Those jobs turn into expenditures. I don't know how many charts I put up for expenditures regarding the growth rate of what's going on with consumers. 70% of this economy is consumer driven. So if we got an increasing number of people being put on the payrolls, you'll see an increase in expenditures. That will drive up price pressures. So this is, you can see there's a correlation here between personal income growth and the money supply. And it's just a reaction to businesses borrowing, building facilities. We are in a manufacturing boom. One of the highlights to Biden's administration, COVID shut things down. Biden switched gears, did his anti-inflationary bill, and didn't fix the avian bird flu. I know certain areas there are no eggs on shelves. We're actually doing okay here in New Mexico. I got full shelves of eggs. Regardless, you're seeing growth rates because of that. This turns into revenue for companies. All right? Personal incomes, 70% driven economy for consumption turns into revenues for companies. So you can take, it's not a one-for-one correlation. Obviously, you can see this, but the S&P 500 versus the M2 money supply, fairly heavily correlated. If there's more and more money, if there's more and more being put into the system, and there's more and more people being hired, and those people consume products, services, this means higher revenues for companies and bigger profits. It's not rocket science, but when you start putting it together, then you ask the question, okay, but what's next? Inflation. Plain and simple. More and more money, more and more development, more and more hiring, more and more price pressures. This is going to be on its way. Next week, we have 3 data points. The world is looking at 1. Anybody who wants to stay ahead of the curve, looking at, so we got Tuesday, Wednesday, and Friday. Tuesday and Wednesday is the Federal Reserve. Tuesday is also money supply. Federal Reserve Wednesday with announcement. Friday is personal incomes and personal expenditures, along with the PCE price index. We don't care about it anymore because we already saw CPI. That's basically how that boils down. Federal Reserve is very likely to be modest in what they say. We're data dependent. We're data dependent. We'll look at the data. I'm looking at the data. The money growth, the fuel, the nitro in this being pumped into this economy, the jobs being created, actual printed, will turn into price pressures. The Federal Reserve will have to pivot. For now, everybody's looking at this saying, well, as long as the Federal Reserve doesn't do anything drastic, we should be fine. SPY ETF pushing new all-time highs. This all makes sense now that we don't have tariffs. February 1st, bluffing. Maybe 3, 4, 6 months from now, one thing pops up. Unfair trade practice. We're going to do a tariff on this one thing. Okay, great. This economy will move right along. Would we gain anything? meh. If you want to stay ahead of the curve, you have to take a look at the entire picture, stand back and say what's going to happen next. The stock market will continue to soar until the Federal Reserve steps in and says, whoopsie, we lowered interest rates too fast, too soon. Therefore, we need to raise interest rates. That's one option. The other option they could announce is, we believe that the interest rate, given the economic growth pace at this point and future policies, if they dare mention those words again, they did in their minutes. Given those two variables, we believe that interest rates are appropriate at these levels. We're going to take advantage of something and reduce our balance sheet at a very rapid pace. That would be interesting. Would the Federal Reserve do that? They always fall asleep. They always get it wrong. You start with that assumption. You've blown it every single time. You're not a rocket scientist all of a sudden. So we will see SPY ETF continue higher, 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 higher. Going into Wednesday's number, there's going to be a little bit of anxiety from the stock market itself. If you did not catch it, yesterday I put a video up on SVOL ETF. This is an inverse ETF to the VIX. Watch that video, because Wednesday, going into that, everybody's going to be pushing put call ratio higher. It will spike up somewhat. And assuming that the Federal Reserve very blandly just sort of talks things down like they normally would because they don't want to crash anything. If the Federal Reserve takes a modest approach to what their statement is, we're data dependent. We're going to be looking at the data. Everything's about the data, which I believe they probably would. You'll see the VIX spike up because people will want to sort of make sure there's no real risk in their portfolios, so they'll buy some puts. This will drive the VIX higher. Then the Federal Reserve is going to go ahead and basically do nothing. And as soon as they do that, SVOL, an inverse ETF. This is the one I'll be jumping in. Just got out of a trade yesterday. And then some from previously, because of the risks involved. SVOL ETF spiked up because everybody assumed that there would be a lot of risks. Those risks didn't materialize, and because of that, the VIX fell, SVOL went back up. I've been playing SVOL for some time. It's been in my trading platform for ages. I always take advantage of it. And over the past, say, 6-9 months, I've been like, that's so easy. Let me go ahead and pick up a small amount. That's easy money. If you want to make easy money in the stock market, that's the easy one right there. You wait for everything to spike up, and when the market doesn't get the fear, the VIX falls back down, SVOL moves right back up. You're not going to make $1 million off that in one trade. You might pick 10, 15, 20 cents out of it. For a scalper, perfect. And that's what I'm looking to do going into Wednesday. If we get a mundane Federal Reserve, that's my move going into next week. But I'll know Tuesday with the M2 money supply what the future looks like. No one's paying attention to that. Friday, I'll be looking at personal incomes and personal expenditures. Just got a whole bunch of people hired. Now they're bringing in a paycheck and they'll start spending. This will drive up price pressures with consumption 2, 3, 4, 6 months down the road. The market is not going to be paying attention to that next week. And it's something I'll be keeping in the back of my mind, and I'll continually put this kind of content out there talking about SPY ETF will continue higher. We have an economic data point that going into this, there are some risks, and therefore, once those are out of the way, assuming the Federal Reserve maintains a normalized, balanced tone, SVOL ETF I jump in on. make sure to check out that video from yesterday. I break all that down. But that's my sort of breakdown of what we can expect next week, the next 2-3 months, assuming zero tariffs. And let's see what happens with the tax credits, how long that takes. They may expire worthless, and then we don't see anything until the budget at the very last minute, at the very end of the year. Actually, the fiscal year is October. So this summer. We'll break that. I'll continually break this down. Make sure to hit that like and follow button. If you'd like this written down and help support the site, Substack link down below. I am putting a lot more of my trades up in my Substack notes. You don't have to be a subscriber for that. You can just follow me on Substack and I'm in the feed. Lots of tons of great written content on there. Make sure to check that out. We'll see you in the next video.